Alrighty guys, so right off the bat here, what are the most undervalued stocks in the stock market right now, in my opinion? Well, here's what they are. In my personal opinion, for the Mag 7, the most undervalued Mag 7 stock right now is Google McDougal. Like, Google is very attractively priced. Let me show you how attractively priced the stock is. Alrighty, I pulled up 1000xstocks.com here. I want to show you Google McDougal and how attractively priced this stock is. So we're looking at a forward P on the stock of under 20 for Google, and all its growth, it's all its great numbers. It just reported a grade A income statement for this company. The numbers were phenomenal. Couldn't have been better, really, out of Google. So, I mean, I just think this stock is very, very undervalued given the growth this business model has. Now, next up here, I said for big tech, the most undervalued I can find is AMD. Now, AMD can be a little tricky. And let me show you how AMD can be a little tricky here. So if we type in AMD's ticker symbol, we're going to get a forward P of 47. Now, that looks really high. And you say, wow, how could that be undervalued at a forward P of 47? That's like, we can call it like a double up of where the market in general trades at roughly for a forward P, right? Here's the thing with AMD. One, I expect their earnings per share to be far higher than where analysts are at. So the reality of that 47 forward P is not 47. It's probably about a 35 or a 37, maybe a 40 max. So that's first part. Second part is AMD's got such ridiculous growth rates, in my opinion, going on for the next several years that forward P is going to come down dramatically. And even if we're looking at analyst estimates here, which once again, I think analysts are way too bearish on AMD. I don't think I think AMD is going to blow analyst numbers out of the water. But when you look at analyst numbers, look, it goes from a trailing 12-month P of 119 down to 47 down to 26. So AMD's profitability is exploding higher. And we're going to really start to see that over the next few quarters, by the way. And so the reality is AMD's a lot cheaper than it looks on surface level here, okay? Because that earnings per share is going to absolutely be booming. Now, next up here said my most undervalued stock I can find under $10 billion is, what is it? It's cake. Cake. You know I love that cake. And so here's a deal with cake. We're looking at a stock that's trading forward P of 18, right? So we're already pretty much, under like a market multiple for the stock. But the thing with cake is I also think they're going to be much more profitable than what analysts have here, so that forward P is actually lower, in my opinion, than where it's at. But the other thing with cake is they got the next 10 plus years of growth ahead of themselves with North Italian Flour Child expansion. So the reality around cake is this stock is way, way, way too cheap given the growth trajectory of the business for the next 10 years. It's not just about AMD is more of a play on the next few years of a massive growth cycle in AI chips, right? And what they're doing with MI350 now hitting the market and MI400 next year and then the MI500 series after that. That's more of like a next, 3 to 5 year play in terms of kind of thinking about AMD. Cake, this is a whole different ballgame. Cake is really thinking about the next 10 to 15 years in growth opportunity there. So Cake's trading way too cheap here. And then the number one stock I can find, in my opinion, that's undervalued, that's under a $1 billion market cap is Honest Company, HNST. HNST is an under $1 billion company. And so for that, what I'm going to show you guys is a compare feature here on 1000xstocks.com, right? So, and if you ever want to apply for access to 1000xstocks.com, you can go to 1000xstocks.com and you can apply for access. But what I want to show you guys here is I want to show you Honest versus their peer type companies like a Kimberly-Clark, like a Procter & Gamble. And since Honest is just getting a profitability, you want to compare these companies really on a price to sales ratio basis. And so what we're going to find here is on a trailing 12-month price to sales ratio basis, Honest is trading 1.36, Procter & Gamble's trading at 4.4, and Kimberly-Clark's trading at 2.1. Now keep in mind, Honest is growing way more rapidly than Procter & Gamble and Kimberly-Clark. And it's not even honestly close. Like, look at the trailing 12-month revenue growth of Honest, double digits, right? Look at the trailing 12-month revenue shrink of Procter & Gamble and the trailing 12-month revenue shrink of Kimberly-Clark. Procter & Gamble and Kimberly-Clark businesses have been literally in decline, right? While Honest is over here actually growing strong. and yet they're trading at a far cheaper price to sales ratio multiple than Procter & Gamble and Kimberly-Clark. Honest is on its way over the next few years to get into that price to sales ratio of, let's call it 2 to 4, which is where it should be long term, as long as this is a public company. Now, also, when it comes to Honest, I think it's a great buyout candidate. I think it would be a great, like, honestly, if Procter & Gamble, Kimberly-Clark, any of these companies were intelligent, what they would do is they would buy out Honest in the next year. The reason Honest is such an attractive acquisition target is you're getting a great brand that has many product verticals, and some of these places these other companies don't compete very strong in. Additionally, you're getting a company that now has very healthy margins and is now standing on its own 2 feet when it comes to profitability. That's very attractive. And so what you could do to scale, because what you would do with a company like Honest if another brand acquired it, is you would likely cut some staff because a lot of roles would be like duplicated roles and things like that, right? So you get more cost out of the business, and the profitability of just Honest would end up increasing rapidly, essentially, okay? And the other component that I think would be very, very attractive for Honest, if a company wanted to approach them and go ahead and buy them out, is the fact that that company has one of the most pristine balance sheets of any stock you'll find under $1 billion in the entire world. They're cash loaded and they're debt free. So it doesn't get better than that. Now, what do I think, if Honest was to sell out to another company, what do I think is a fair price for Honest? I would put fair market value at Honest at somewhere between, and this is right now, like assuming, let's say somebody tried to buy Honest right now, what's the share price they would need to pay today, not 5 years from now, today? I believe anywhere between about $10.50 and about $14 is a fair price for Honest if they were to be acquired today, which is nowhere even remotely close to where that stock's trading. That stock's under $5. And I think fair market value today, if a company wanted to buy them out, would be between $10.50 and about $14. That would put their price to sales ratio more in that 2 to 4 range. Given the growth the business has, given the now getting to profitability, you'd be able to get cost out of the business. You're getting a great balance sheet there. You're getting cash given to you for buying Honest because they're debt free and they got cash. So it's not like you got to worry about if you got to buy out another company and they're debt loaded, you're like, crap. How are we going to deal with this debt load? We're buying this company, got $500 million of debt, blah, blah, blah. It's a problem, right? Honest doesn't have that, stress-free. So, yeah, we'll see what happens. But Honest is definitely very, very attractively priced. No, me in regards to Tesla, I was a Tesla shareholder, obviously, for a long time. It did me phenomenal, made incredible gains on the stock. Ridiculous, right? And so what would it take, and obviously now I don't own any Tesla shares, so what would it take for me to buy Tesla stock back? That's a big question, right? So I put on X, I said, these are the 5 things it would need for me to buy Tesla shares back. I said, 1, I would need to be confident they can grow automotive sales again at a 20% plus CAGR, compounding annual growth rate. If I could be confident in that, then we're talking, right? As of right now, their automotive sales are literally in decline, quarter after quarter, just going down, 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 right? So, 1, they need to reverse that and then start growing. If they could do that, then we can talk, and then if we talk about getting to like a 20% plus CAGR, then we're then we're looking good, right? 2, we need major valuation decompression here, okay? Which is just a fancy way of saying the stock needs to go down a lot. Because Tesla's trading at such a ridiculous valuation here, I mean, it's just absurd. Given how bad the business model is, it's absurd. The sort of, it's at a Ford P 196. 196 would be completely fine for Tesla if they were growing revenues 50% plus. The fact is around Tesla, the revenues are in decline. It's not a debate, it's fact. Like their revenue was down 12% this latest quarter. Automotive was down 16%. It was a dumpster fire. And then imagine when all these energy credits get taken away. What's their profitability going to be then, right? So, yeah, the stock would need to go down so much for me to even be interested in it. I said the third thing is earnings per share. I need that to stabilize and consistently start growing. If that can happen, then we can talk, right? And that's a long way from that. 4, gross margins and net margins have to start consistently growing. That's a big question. Like, margins have not been headed the right way, right? If gross margins and net margins can consistently start growing, then we're talking. And I said, Elon has to quit doing stuff to hurt the brand. He has to stop doing stuff to hurt the brand. He's done a lot. I think this company would be consistently growing if he hadn't said all the things and done all the things he's been doing the past few years, but he's done it. It's hurt the brand bad. It's reflected in their auto sales, right? Their auto sales are a disaster. They're far under like what an average company's doing. And they have such phenomenal products in the market. But if you hurt the brand that bad and you make that many people mad, right? Like, people just don't have a very good feeling around going to buy a Tesla, right? A lot of people. And so for that reason, he's got to completely reverse this. I said under $200 is okay for Tesla at this stage. Like, if you can get it at like 180, 170. Under $100 is ideal for Tesla. Over 300 is a horrible risk reward for the next 2 to 3 years. So many more attractive risk reward profiles. The business has just, over the past year specifically, it's just gotten so bad. So bad over the past year. The numbers are just a disaster. What Elon's done to the brand is just a disaster. Like, up until about a year ago, like, Tesla still had a good chance of like making things happen, but given Elon's, making so many people mad on both sides of the political party, it's been ugly, man. And their numbers have just deteriorated again and again and again. What are you gonna do? You know what I mean? The problem is it's just not showing any signs of like flipping the other way. So then you have to count on robotaxi. Robotaxi, here's the issue. It's not as big of a market as people think. It's not. Look at Uber, right? Like, Uber, you think, given how excited people are about robotaxi, you think Uber is like the biggest company in the world. No, they're not. And, you say, okay, we're eliminating the driver in the seat. Okay, that's cool. They'll make it more profitable, right? Over time, but not initially. You could lose money on that business model for years to go in the future. Ask Waymo. Tesla's like, oh no, we're just going to make money. Baloney. That's what they said a lot of times. And then they don't, right? And so Tesla will lose money in robotaxi for likely years to go in the future. People assume they're just going to like launch this thing and they're going to be making so much money. No, from what I heard, I haven't got a chance to listen to a conference call. I even heard some people on X, some of the Tesla fan folks talking about like, Tesla's talking about if they have to take out debt, they'll take out debt. What? That's crazy, man. Like, there's no reason Tesla should have to be taking out debt. The fact that that's even a conversation is scary, downright scary, okay? So the moral of the story is, in regards to Tesla, it's just a very boring blah stock. It's not interesting at all because it's already priced in best case scenarios in so many different ways that it's just not exciting. There's just so many better opportunities out there as for investments. It's not even funny. Never mind if we end up going into a bear market in the next year or two. We go into a bear market in the next year or two, Tesla will get taken to the slaughterhouse so much more viciously than most stocks out there. It will be nasty. Google McDougal. I'm looking forward to getting this one. By the way, in Tesla, keep in mind, from the 2021 peak to the 2022 / beginning of 2023 trough, Tesla fell about 70%, folks. Keep this in mind. Tesla was in way better of a financial situation at that time. The margins were dramatically higher than they are right now. The revenue looked way better. The revenue growth looked way better. The profitability looked way better going into 2023 than it does right now. And everything's way worse. So what do you think would happen if we got a real bear market? S&P 500 went down 25, 30, 40%. To think Tesla couldn't go down another 70 to 90%, that's definitely in the realm of possibility. How would you like access to all my best course curriculums? My Becoming Master of the Stock Market course, my Stock Market Investing Mastery course, my Stock Options Mastery course, my Millionaire Playbook. How would you like access to all my best courses
as well as the ability to have access to my 6 and 7 figure plus Discord community, where we're constantly keeping in touch with each other, talking about what's going on in the market. How would you like exclusive weekly videos from me? How would you like the ability to see what stocks I'm buying and selling in my $2 million plus Fidelity account? If that all sounds pretty interesting to you, apply to join my private group. That is going to be linked in the description area down there. You can click on that, fill out an application, and go ahead, hop on a call with Andre. Andre will walk you through the whole process. He'll walk you through the whole group, and you can go ahead and join us in there. Once again, the link for that is in the description area.
Here's the deal with Cake. Very strong results last night they posted. B plus income statement here. $955 million of revenue they did versus the same quarter last year. They did $904 million of revenue. Also looks like they had an extra day in there last year. No, food and beverage costs actually fell for the company on a year-over-year basis. That's phenomenal. That's a big line item there. That fell to 21.6% of revenue. Additionally, labor expense was that's the biggest category for Cheesecake. Gotta always watch labor, man. Labor fell for them as a percent of revenue, down to 34.9%, which means they're operating their restaurants very efficiently. As far as other costs and expenses, that was up a bit for them on a year-over-year basis, and G&A was up just a tad bit, but they are growing a lot of restaurant count right now, so I'm not surprised G&A grew a little bit there. Now, as far as total costs and expenses went, that was 93.2%. Oh my gosh, Meta. 93.2% total costs and expenses fell to as a percent of revenue versus 93.5% in the same quarter last year. So that's a good number there. And they continue to expand that number. Income from operations went to 6.8% from 6.5%. Income from operations went to almost $65 million in this latest quarter. If you look at net income, $54.8 million for them as far as net income goes. Okay. Now, income tax provision hurt them quite a bit in this quarter. That was 0.8% of revenue. So that was $7.4 million hit versus the same quarter last year was only $3.9 million. So they kind of got hit in a negative way. Income taxes can move up and down. No, diluted EPS, $1.14 versus $1.08. Very strong results. Is this a meta type quarter? No. But is this a very strong results from a very strong company? Absolutely. Now, what makes this even more impressive, okay, you've got to always compare companies versus their peers. So for instance, look at Google's revenue growth and then look at Meta's revenue growth. They're two kind of peer type companies. Meta's smashing Google. Like Google, very respectable numbers they had, but Meta's a whole other level. Then when Apple reports tomorrow, compare Apple versus Google. Another great comp, and see what the results are. And you'll probably find, hunch is you're going to find Google smashing Apple, okay? So you want to compare restaurant companies against restaurant companies. So a great comp would be, look at somebody like Chipotle. Chipotle just came out with numbers a few days ago. What did Chipotle have for numbers, right? Their numbers were bad, folks. Bad. Look at Chipotle. Chipotle's income from operations fell on a year-over-year basis. Additionally, Chipotle's net income fell on a year-over-year basis. No bueno. Cake's coming in with impressive top-line numbers here, right? Growing revenue, $51 million in the quarter, but they're also coming in and growing their net income in this latest quarter, growing their diluted EPS, and growing their income from operations, right? Income from operations for Cake grew to almost $65 million from $58.6 million, right? While Chipotle's over here having income from operations go down from $586 million to $559 here. It was a tough quarter for the restaurant business, the casual dining business, anything you want to throw into that category. And Cake came in and they said, yeah, it's tough. And we're still going to put up numbers, right? That's big. Additionally, I listened to the Cheesecake Factory earnings call last night, right, while I was still in Charlotte, North Carolina. Banger of a conference call. Go to 1000xstocks.com, listen to the latest conference call. Don't just use our AI feature, okay? We have our new AI feature, which is phenomenal, right? And it can kind of give you an understanding of what happened on the conference call and the big moments and things like that, right? But listen to the full conference call. Listen to the full conference call. You will get educated on a very high level with what's going on with Cake. I could not be happier. Now, something big they did mention on the conference call. This was huge, I thought. They mentioned about this new North Italia they opened in kind of like Boise, Idaho area, right? and they were talking about it's like 40% above company average for sales for North Italia. My guess is with North Italia, right, and this is a huge expansion opportunity for them over the next 5-10 years. It's the second biggest expansion opportunity for them outside of Flower Child, right? My guess is they're probably getting better about picking locations. And so I think this next group of North Italias is going to be even better numbers than the previous group, essentially. So, man, I mean, just, and with consumer sentiment as bad as it's been, like, what happens when consumer sentiment gets good? I mean, can you imagine North Italia numbers then? Jeez. No, this is cake. Cake's a freight train, okay? Cake is a freight train. A freight train, it doesn't move that fast at first. It doesn't have the fastest acceleration. But once it gets moving, you look out. And that's what Cake's doing. They're opening their new Flower Childs, their new North Italias, their other concepts. And that's just going to continue on. And, we got years of expansion ahead, man. Years of expansion. And so that's why I love Cake I don't just love Cake because of what's going on with the numbers short term. I love Cake for what's going to happen with this company over the next 5-10 years. It's beautiful. And the best thing is, I don't even have to worry about selling Cake shares. You know why? Because they pay out those sweet dividends every 3 months. So those dividends come in. Gorgeous.
How would you like access to all my best course curriculums? My Becoming Master of the Stock Market course, my Stock Market Investing Mastery course, my Stock Options Mastery course, my Millionaire Playbook. How would you like access to all my best courses, as well as the ability to have access to my 6 and 7 figure plus Discord community where we're constantly keeping in touch with each other, talking about what's going on in the market? How would you like exclusive weekly videos from me? How would you like the ability to see what stocks I'm buying and selling in my $2 million plus Fidelity account? If that all sounds pretty interesting to you, apply to join my private group. That is going to be linked in the description area down there. You can click on that, fill out an application, and go ahead, hop on a call with Andre. Andre will walk you through the whole process. He'll walk you through the whole group, and you can go ahead and join us in there. Once again, the link for that is in the description area.
PayPal, next up here. PayPal down 9% today. Is it really that bad? What's going on with PayPal, right? So here's the deal with PayPal. It's actually pretty good. It was a B plus income statement that PayPal put out here. Revenues went to $8.28 billion from $7.88 billion in the same quarter last year. Transaction expense was hardly up for the company year over year. Transaction and credit losses, that one was up quite a bit. That was up, we can call it around $140 million. Was that $141 million roughly there? Customer support and operations actually fell for the company year over year. Good. Sales and marketing was up significantly. They're spending a lot on marketing recently. A lot of marketing. So that expense is really big right now. I think they should moderate in 2026. Technology and development, 767 versus 718 million in the same quarter last year. General administrative, they dropped that significantly, $461 million versus 570 in the same quarter last year. Restructuring and other was roughly flat year over year. So total operating expenses went to 6.78 billion from 6.56 billion. Operating income went to over 1.5 billion dollars in this latest quarter versus 1.3 billion in the same quarter last year. Net income went to $1.26 billion from $1.12 billion in the same quarter last year. Diluted EPS went to $1.29 from $1.08. That's extremely strong double-digit diluted EPS growth. And how are they getting that? Well, one, their net income's up quite a bit year over year, right? Their net income's up over $100 million on a year-over-year basis. But look at the share count. Their diluted shares fell to 877 million shares from over 1 billion shares in the same quarter last year. This is a dang good quarter by PayPal. This is nothing to be ashamed of. This is a B plus, extremely solid quarter. What about the guidance? Well, the guidance looks pretty dang good for the most part. The GAAP EPS are expecting $1.14 to $1.18 this next quarter. That's versus 99 cents in the same period last year. That's strong growth. Now, non-GAAP EPS is the one number that's asleep. They're expecting $1.18 to $1.22 in this quarter. They're about to, this next quarter essentially, versus prior year period $1.20. So that non-GAAP EPS for this quarter looks sleepy. But look at the fiscal year 2025 in general numbers. GAAP EPS 490 to 505, right? The old estimate was 480 to 495. So that's a nice up number there. And a prior year period was 399. So huge up. Non-GAAP EPS 515 to 530. Versus 495 to 510 was a previous guide from just last quarter. So they're already getting much better, right? Previous year period 465, so Really strong guidance here. So what's the issue with PayPal? I'll explain the issue for PayPal. It's a boring stock. That's the issue. The forward P 14 on this stock, right? The numbers very strong, balance sheet very good. They're sitting on cash and investment loads to the sky. They're buying back shares left and right. They make bank, but it's boring. That's the issue with PayPal. This is no SoFi. People love SoFi. They love buying SoFi stock. You know why? Because SoFi comes in and shocks you. SoFi comes in with growth rates that flip your flapjacks, right? I mean, 40% plus revenue. Like, what are we talking about here? PayPal's not going to come in with that number. So PayPal's boring. So it makes it for a good investment, but it doesn't make for a great. It's not like PayPal's not one of those stocks that's like, oh, this is a 10x opportunity. Like, this is the next 10x, right? No. Like, PayPal's just a good, solid company that puts up good, solid numbers and trades at a forward P of 14 under a market multiple, right? That's the issue with PayPal. So it is what it is, but the numbers, you can't say anything bad about the numbers, though. That's just the bottom line. You can't say anything really bad about the numbers. Like, they're all really solid, really good numbers. It's just a little sleepy. So, and sometimes you need some sleepy stocks in your portfolio. Not everything's going to be a Palantir or a SoFi. That's just the bottom line with that, right? There's going to be some stocks that are just good, steady risers. And I think that's what PayPal will do over time, but it's a little sleepy. It's a little boring, right?